Let's ask iCapital's Anastasia Amoroso. She's live with me here at Post 9. It's good to see you.
Good to see you.
All right, bear bounce or more?
I think we're getting exhausted on the bounce that we've had. I mean, if you think about it, 4,200 on the S&P is probably as high as we're headed. But I will say the talk of the tape to me is I think we want to trade a little bit better. There's just a more constructive tone to it. And I don't know if it's fundamental necessarily, but there's a lot of technicals that are at play. We talked about this, Scott, I think a couple of weeks ago. Once we crossed that 50-day moving average, the CTA community really could step in. And it seems like they've been doing that. We've got past the earnings season, and it was not as bad as feared. And now, by the way, 60% of the companies are out of their blackout buyback periods, and 80% of them will be by the end of the week. So it's just from a technical perspective, there is a lot more money that could potentially get engaged there. And by the way, the Fed pivot, a lot of people kind of dismiss that from last week.
We're going to talk about that.
But I think there's something constructive to it.
Okay, so you really think it was a pivot? You had your note says, despite another supersized 75 basis point rate hike, the Fed delivered something for markets and consumers to cheer about. I mean, did they really? Because others are out suggesting that, no, the markets are getting this totally wrong.
I know, and there's been some Fed communications that are trying to walk back sort of the dovishness of the statement. But to me, there's three things that Powell said that really kind of underline the fact that they do actually want to pause here. The first thing I would say to that is we're at neutral, and they know that the economy is not great. So they do know policy acts with a lag. They want to kind of pause a little bit here. Then the second thing is if you look at the financial conditions, they have tightened to the 20-year average levels. And Powell said explicitly that tightening is still going to exert downward pressure on the economy. And then, Scott, you saw the GDP last week. You saw the ISM number this morning. You saw the job opening numbers that are likely to trend down. The Fed knows that their policy is working. The economy is slowing down. So why not just be a little bit cautious here and just see how this plays out? I'm not saying they're done with rate hikes. I'm just saying I think Powell really does want to achieve a soft landing. And if he does, the next move is to slow down.
There are some who don't believe that neutral is what the Fed chair says neutral is right now, that it's still too accommodative to get inflation under control and to crush demand. And that really is the central question. If that is not neutral, how far beyond neutral will they need to, in fact, go? To me, the whole thing rides on that question. Yeah. If they need to go way past, then all the bulls about the Fed are wrong.
I think we won't know this for about a year. And hear me out why I say this. I think near term, there is a great case that is being made for them to pause. So we get to 2.5, 2.75, maybe we get to 3.25 by the end of the year. And they want to pause and assess how all this tightening affects the economy. But the reality, Scott, is that they might crush the durable goods inflation. They might crush some of the housing market, inflation per se. But if you look at the shelter inflation still, if you look at the wage inflation, that's not likely going down to 2%. So I can see them pausing, slowing down, assessing the economy, and it may be that in 2023 they have to step it up again, but we just don't know that yet.
Do you expect the Fed to cut rates next year?
I don't.
Because the market's trying to get there. It's already kind of there.
Yeah, I think the 10-year pricing in particular has gotten a little bit ahead of itself. I mean, if you look at the 10-year Treasury, it's really pricing in a great deal of an economic slowdown.
260, is that where it is as we're having this conversation?
Yeah, 265. It was just at 350 just a little bit ago. So I think it's pricing in a whole lot of a slowdown and a recession. So
at 258, what is that, 259?
I would be taking the other side of that. I think there's value to be had in the front end of the curve, but I would be taking the other side of the 10-year Treasury. And I suspect that as we work through the first Q and second Q of negative GDP prints, we'll likely see better GDP in the second half of the year. And with that, I suspect that the 10-year should move higher as well.
Okay, let me just remind everybody, we're seconds away, literally, from more earnings flooding the tape. Activision Blizzard expected any second. Within the next couple of minutes, Pinterest as well. And we're going to break in exactly when they cross, and we'll show you the stock moves. Just give us a moment as we wait for all of that to happen, and our reporters to go through it. We'll tell all of you about it. There are some who simply say earnings not as bad as everybody thought. You mentioned that earlier, and that everybody just got too negative. And the market's priced in way too much negativity. Marko Kolanovic, J.P. Morgan today. The S&P has seen its second sharpest PED rating of the past 30 years, exceeding the typical compression seen during prior recessions. The risk reward for equities now looking more attractive as we move through the second half. Peak hawkishness is now likely behind. You agree with that?
So I'll take two sides of that. First of all, when we were talking about 15.5 times price to earnings, I would have said that's exactly right. We've priced in too much already. We're now at 17.5 times and 247. So I think that's why I think we might be approaching the top of the range.